In previous videos, we talked about how budgets are a very useful tool for both planning and control. But what if the activity level that we expect when we put together the budgets, for example, the number of units that we're going to sell, right? So the number of units ends up being different from what we planned. Then it's not so good to use that budget for purposes of control. We actually need to make some adjustments, which is where this idea of flexible budgeting comes in. So that's a little abstract. Let's jump into an example, and I'll make it a little bit easier for you to understand. So let's say that you own a movie theater, and I've constructed a rudimentary budget here, and I will walk you through how I constructed that budget to make it a little easier for you to understand. So let's say that the number of customers we expect when we make this budget, we expect customers, let's say customers of 10,000. 10,000. So customer, and we'll just say customers are Q. So Q is our quantity. That's the number we're expecting. Q is 10,000. Okay. So when we put together this budget, it's all under the assumption that we're saying, well, we're going to have 10,000 customers at our movie theater for this month, right? Let's say it's for the month of December, and we're saying, okay, well, what's going to be our revenue? Now, in reality, most movie theaters would sell popcorn separately. They sell soda separately. They sell these, so you have these different revenue streams from concessions and then from ticket sales. But let's just say at this movie theater, we just say, you know what, it's $10 for every customer who comes in, and the popcorn, everything. We're just going to make it a really simple example. So when we have 10,000 customers, we just multiply that by 10. That's why I've got 10Q over here. That's our formula. 10Q is our formula for calculating our revenue for that month. So we just say 10Q, and then Q is 10,000. So that's just 10 times 10,000 is going to give us 100,000. That's how we budgeted our revenue for the month. Now, when we look at our expenses, we've got our expenses here. So we've got popcorn, soda, candy, so forth. These three expenses are also going to vary with the number of customers, right? So we're expecting that based on, here, let me just back up. So with 10,000 is our Q right here. We're going to multiply that by 0.25, see that formula, to get 2,500 as our budgeted expense for popcorn. Likewise with soda, we take 0.1 times Q, which is 10,000, times 0.1, and that gives us 1,000 for soda. And then so forth, we have 0.5 Q. So 0.5 times 10,000 is going to give us 5,000 for candy. And then the wages, rent, and insurance we're treating as fixed. Now, it doesn't have to be that way. Some firms you might say, hey, well, with the wages, we're going to have a fixed component, but then we're also going to have a variable component. For example, let's say a retail store says it's holiday season, and they say, well, we expect that we're going to have 50,000 in wages expense, but for each additional 1,000 customers or 1,000 customer orders, we're going to hire another person. And so you've kind of got like this double, you've got a fixed and a variable component for a store like that. But for us, for our purposes here with the movie theater, we're just going to say that it's a mom and pop movie theater, and they say we're not hiring anybody else. We're just going to treat wages as fixed, and so it's 40,000, and then rent of the building, no matter what the Q is, right? So we're just going to say that we're not renting another building. That's fixed, and then also the insurance costs are fixed as well. So when we go ahead and take our budgeted revenue and subtract out all our expenses, we're going to end up with a budgeted profit of $19,500. Now, this is all old hat. We've done this before, but what if this Q changes, right? So what if this Q, let me just change colors here. What if this Q were 12,000? Now, you might say, hey, we'll just come up with a different budget. But what I'm saying here is we budgeted 10,000, but then the actual Q, let me just stress this here. The actual Q turns out to be 12,000, right? We didn't know that in advance. We thought, hey, our best estimate is 10,000, and so we came up with these numbers here based on this 10,000 expectation. But in reality, it turned out that it was 12,000, right? Now, if we're going to judge or evaluate our managers on how well they controlled costs or so forth, or how our spending was or any of these things, wouldn't it make sense that we say, okay, well, we kind of made a mistake here with how much we budgeted for the number of customers. We had more. Maybe we should make some adjustments. And let me give you an idea of how that might make sense. So let's say that popcorn, the actual popcorn cost, let's say that the actual popcorn cost was $3,200, right? And you say, hey, let's look at the managers. Our budgeted popcorn was $2,500, and it would ended up being $3,200. Obviously, our managers did a bad job purchasing the popcorn. They got really bad prices. But hey, wait a minute. We actually had 2,000 more customers. We had 12,000 instead of 10,000 customers. So shouldn't we expect, since popcorn, the amount of popcorn expense is a function of the quantity of the number of customers, shouldn't we expect that since more customers came in, they ate more popcorn? Of course we should, right? Of course. And so therefore, we want to make adjustments to our budget, right? We want to adjust this budget. We don't want to just treat it as this inflexible thing. And so what we're going to do is we're going to create a flexible budget. And let me change colors here. So we will call this our flexible budget. And all we're doing is we're taking the formulas that we had from to create our original budget, right? Our original budget, we said, okay, 10Q is going to give us our revenue. And now we're saying, now that we know the actual Q, let's figure out what our revenue should have been given the actual Q, right? Given now that we know that it was 12,000, what should our revenue have been? What should we have expected it to be? And so we'll just take 10Q is going to yield our flexible budget number for revenue. So that's going to be 12,000 times 10, right? So we get that, and that's 120,000. Let me change colors here again. So that's 120,000. Okay? And then we can actually say, let me just run through the flexible budget numbers first, and then before we get into the idea of variances and comparing them. So our popcorn, 0.25Q, but now we plug in 12,000 for Q. Okay? And what's that going to yield? That's going to yield $3,000. Similarly, our soda is 0.1Q. What's our Q under the flexible budget? It's 12,000. So we're going to take that 12,000 and multiply it by the 0.1. That's going to give us 1,200. And in the interest of time, I'm going to run through some of these a little faster. So our candy expense would be 6,000, just following our formula. Now wages, rent, and insurance are going to be fixed, so that means they don't vary based on changes in Q. They're just fixed. It doesn't matter what the quantity level is, how many customers, our rent and insurance and so forth are always going to be the same. And so now we can go ahead and we can come up with what our profit should have been under this. So we have 37,000. Let me change to green for consistency's sake. So we have 37,800 is, now this is just saying we're just adjusted the budget, right? The flexible budget is still a budget. These are not actual numbers. The only thing that's actual here is the 12,000 customers that came in. And so we're adjusting our budget. We're saying, whoops, we made a little mistake here when we estimated how many customers. So given that we actually had 12,000 customers, what should these things have been? Let's use those formulas to calculate a new budget. Now we can say, oh, okay, hey, look, given that we had 12,000 customers, we should have expected a popcorn expense of 3,000. So now we can actually go, and I'm going to make another column, and this is actually going to be called a variance column, our activity variances. And what we mean by variances, we just replace that word if you want to think of differences, right? So we're just thinking of differences. And so, you know what, I'll just put all the variances in white here. So when we compare, what we're doing with the variances are, we're just comparing the flexible budget numbers to the original budget numbers, right? So we say, okay, for the flexible budget, we were 20,000 more than what our original budget was. So that 20,000 difference is a variance, right? And now, is that a good or bad thing that we had? Well, we'll think about it as we had more revenue than what we expected. So we'll say that that's good, and we'll call that a favorable variance. So F is favorable. I'm just going to put F there. And then now when we think about, so we've got this activity variance, and this is just saying we had 20,000 more revenue than we expected. Now we think about, okay, popcorn. So we got 3,000 versus 2,500. So we should have expected 500 more in popcorn, right? So an extra 500. Now we spent more, so we'll call that an unfavorable variance. Now that doesn't mean it's a bad thing, right? Just because, we kind of say unfavorable, don't get too hung up on this unfavorable favorable distinction, because in this case we had more customers, and so we'd expect to sell more to give out more popcorn. So it's not necessarily meaning that there's some kind of serious problem. And again, we just take here for the soda, 1,200 versus 1,000. We had 200 unfavorable because we had 200 more, and then for the candy we had 1,000 unfavorable. And then we don't have any variances at all for the fixed costs because they're just fixed, they don't change. And then we can sum up our overall variance, 18,300, and it's favorable. We can just net these, or we can just look at the difference of the profits under each scenario. Now, notice that our initial budget, even though it was wrong, this 10,000, it was useful to us for planning purposes, right? But when we think about control and saying how good a job did our managers do, or before we can even get into any of that, we need to say, well, what was the actual quantity, and then adjust our budget. So that's what the flexible budget is. It's just our original budget adjusted for the fact that we had a different queue, a different number of customers than what we were expecting. And so this is really useful to us, but you might be saying, hey, wait a minute, we still got this elephant in the room. You originally said, and let me scroll down and get a little space here. You originally said, well, what if the popcorn, or maybe I'll just write it on the side. What if the popcorn was 3,200? Right? Well, that's what we said. We said, what if the popcorn is 3,200? Well, that's going to be a completely different type of variance when we start getting into the actual results versus what the flexible budget is. Right? Then we can start thinking about things called revenue and spending variances, which we're going to get into in our next video.